Hey guys, how are you? Is Tech Sparks rock in your life today? Are you learning a lot? Have you met entrepreneurs that are making a difference to your life? I hope all that's happening. I hope you're networking digitally. And this is the 11th edition of Tech Sparks. I hope you're really enjoying it. I've got with me Gaurav Rastogi, CEO at Kubera.in. And it's this fireside chat that makes me want to believe that I can go back and invest in stock markets. I'm really keen to know from him, how investing has changed after COVID, right? So the topic is investing in the new normal. But before that, a little introduction about Kubera.in. The founders are Gaurav Rastogi, who's with us as the founder and CEO. I've got Nilab Sanyal, who's the co-founder and COO. Mayank Sharma, co-founder and CTO. They could not join us in the show, but Gaurav's going to, sail the ship. Gaurav, by the way, is a BTech from IIT Delhi. He was a sales scholar. You also went to the Chicago Booth School, where he's a Siebel scholar. And, he's worked in the investing space in proprietary credit, for over 15 years. And he started up this company in 2016. Kubera has about 1 million users. They call these users happy Kuberians by transforming their lives, and how to invest and save money and, improve their lives in personal finance. It's an AI-driven analytics company that brings transparency to the entire advisory value chain. And currently, they advise on investments, loans, and insurance. As I mentioned, Kubera's leadership has experience in banking, proprietary tech. They worked in Morgan Stanley and Axis Bank and Amagi. So, most of you today who have excess money, savings, want to think about where to invest your money. I think Gaurav is going to tell us all that. Gaurav, welcome to the show. How are you?
I'm good. Thanks, Vishal. Thanks for having me here.
You have a very interesting journey. You've been a scholar. You got two times scholarship, right? How did you manage that? Were you a very bright student when you were younger? How did that happen? And I want to know your journey. You began your journey in Capital One, if I'm right. And how did the starting up journey happen?
See, I started at Capital One, right, and then went and did my MBA. Very, I would say, a safe career path in that sense of the way, right? You graduate in India and you have a company who comes in and says, hey, do you want a job in the US? So my first job at Capital One was in their Richmond office, which used to be their headquarters at that time, right? Of course, you'll say yes, and off you go, and you have your 4 years of fun, and then you're like, okay, what to do next? And everyone says, yeah, MBA is a good thing. Chalo MBA kar lete hain. So then you do an MBA. After MBA, you have like all these options. You can do consulting, you can do investment banking, But it was during my MBA that actually my interest in capital markets started developing, right? And Chicago is a fantastic place if you want to learn about investing, about the history of investing, about how investing is developed, what works in the market, what doesn't work in the market. Very theoretically rigorous, but also very practically grounded in how they approach this subject. So that's where that interest really sparked. And then Morgan Stanley, amazing company, gave me the opportunity to work with them in New York and then in Hong Kong on the prop trading side. So learned a lot. And during this whole time, right, like the understanding always was that if you are really, really rich, then you have all these tools available for you. But otherwise, right, what happens is that, and in India especially, like when I used to look at my dad's portfolio, when I used to see how my dad is being sold mutual funds or being sold ULIP policies, and I would keep on telling him, don't do it, right? But he's a good friend and blah, 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 and I've been with him for 20 years. And that kind of started to trigger something, in my mind, and then started talking to Neil and Mayank about this. And
Nice.
In that sense, what we think of ourselves, we are more like a mission-led company in that sense, right? We don't come from technology backgrounds. We are not growth obsessed in the way that a lot of tech companies are, right? If you look at our backgrounds, we understand finance, we understand technology, but most importantly, we understand how people's relationship with money is and how that evolves, right? It's very complex. In India, the biggest thing that kind of I took away was, in a sense, what happened was that offline mis-selling has now morphed into digital mis-selling.
Yeah.
Right?
And disinformation also in many cases.
Exactly, right. So and finance should be based on trust and transparency. And we think that, online finance is the best place to be able to do this. Offline, there are all these arguments, the cost of educating the end user is really, really high in an offline scenario. And like, your end agent is driven more by commissions, is driven more by how much he sells and how much bonus he makes. He doesn't care about, educating the end user. But in online, a lot of these things change, right? So that's the opportunity, and that's kind of what we want to focus on, right?
Yeah.
In finance, you'll hear this saying a lot. First, they'll sell you greed, then they'll sell you fear, and then
Yeah.
they'll sell you complexity, right? So for retail, it's greed and fear. For ultra HNI, it's complexity, and that's how the entire banking ecosystem makes money.
Okay.
And when we think about Kuvera, we think of it as an anti-sales platform
Yes.
in that sense.
And that's so kind of you to bring that topic up, because retail investing community is very small. Quoted a number of 40 million, but you said it's much lesser than that, right? And you said it's something that we often have to talk about, that number, because for a country like India, India is a rich country, but Indians are poor. That has to change. And how will that change is something we'll get into. I thank you for that honesty. You were right. All of us are sold insurance products in our country as savings products, that you will be secure. But the perception of the stock market is only changing with the current generation. And and I'll also give you a personal example. You know, way back in my career, 20 years ago, when I started up, I had a few savings and I invested in the markets. And the 2008 crash, really wiped out my portfolio.
Right.
And the mistake I made was because I'd gone through ULIP and I'd gone through, growth equity in mutual funds without understanding, because it was an agent sold model back then.
Sure.
Right. And which will change now, because apps like yours can actually guide us better, right? That era was an era of misinformation, like you mentioned, right? On that context, can you tell us how India is changing and how investing in India will change going forward? Because I think that, and people will appreciate that.
Sure, definitely, right. But I'll just take some historical context here, right?
Yes.
I think every generation thinks that they are in the forefront of an investing revolution. Right?
Is that
And
true?
it's true, right? I mean, 2006 to 2008, the number of folios or the number of demat accounts saw a huge rise.
Spike.
What happens is bull markets entice people. Good
Yes.
past returns entice people, right? And that has got nothing to do with how the product actually is being distributed, right?
Correct.
The difference is that in an offline model, and this is something that we talk about very often, in an offline model, what happens is the advice that is given to you, advice, it could be advice, it could be a broker, it could be a distributor, whatever the nomenclature is, doesn't matter. It's given in a closed room. You can't cross-check the sanctity of that advice. Someone comes and tells you ULIPs are great for you, you're sold, ULIPs are great for you. You can't check the sanctity of it, right?
Yes.
Someone comes and gives you an advice, you can't check. What happens in an online, in a digital advisory model, a robo-advisory model, or a digital advisory model, or a personal finance model like ours, is that anything we do is immediately vetted by thousands and thousands of our users. And that is the real strength of this model. The real strength of this model is that everything we are doing, everything, the way we are presenting the data, the way we are creating our portfolios, the way we are showing you what you should or you should not be doing, is immediately being vetted, right? So if you do something which is obviously wrong, people will start questioning.
Correct.
Why is this happening? And kind of that itself makes it a much stronger ecosystem, a much stronger, a more safer place to be. But the basic desire that an individual has, where they see a 40% rally in gold and then they think that gold is going to continue rallying 40%, or where they see Zoom go up 7x or 8x in less than 1 year and they assume that that's going to continue forever, that doesn't change. And it's not just in India, right? I mean, China had the same thing, before the 2007-2008 crash. The number of investors in China grew dramatically. They've never reached that number still.
Yes.
Because after the crash, everyone fled, right? So our understanding is that from 50 to 70% of the people or user or investors who start investing in the last 2 years of a bull market, they don't come back.
Wow.
They lose money in the crash because they lose money in the crash, right? You're buying closer to the peak, you're buying at the peak or closer to the peak, you lose tons and tons of money. When you lose money, you just don't come back, or you come back after 5 or 6 years.
Again, because you're in the same cycle, because you're late again.
Exactly.
Wow. How will that change? That is a fundamental problem to investing in a country like India. I mean, I see that the current day modern apps are changing everything. There's a lot more information. Do you see a new generation will come in and experiment a lot more?
Of course, the new generation will come and they'll experiment with the newer tools that are available to them, right? And
Mm.
that's what leads everyone to believe that they're doing it for the first time. But it doesn't mean, you know, the human behavior doesn't change, right? So effectively,
Mm.
what we see, that there are two different kind of apps that come up, right? So you have these transacting apps. They are purely about transactions and ease of
Yes,
transactions, but they don't care about whether those transactions are right or wrong. Right or wrong is a very strong terminology. The transactions actually improve the well-being, the financial well-being of the investor over the long term.
it's like a carry through, a friend with you saying, "Hey, are
Yes,
you doing the right
versus
thing?" Kind of
yeah. So
advisory.
the transaction apps don't care about this, and then there are the second set of apps where everything is kind of, you know, it's holistic. It's about, okay, I mean, you want to buy it, then sure. I mean, we're not going to stop you. We're paternalistic, but we are not like, you know, we're not going to stop something. But is this actually going to be a good outcome for you in the longer term? And I think that language of fintech has to change. So the way I kind of sometimes contextualize it to some people is, in India, what has happened is that a lot of verticals, a lot of technology verticals have just borrowed the language of e-commerce.
Correct.
The language of e-commerce
Scale,
has been
scale.
hard sell, but exactly, and it's hard sell. Yeah, you have to sell at any cost, right? Now, for transactional models, that works, right? Because transactional models are based on increasing transaction volume.
Yes.
Finance per se, right? Especially personal finance, especially investing, right? Payments is a different beast. So let's keep payment out. Outside of payments, it's all about relationship and it's all about longer term outcomes. Today,
Correct.
if I'm able to sell you a mutual fund, it's not a victory for me. But if that actually leads to a longer term outcome, that where you have a better retirement, where you can afford a better home when you retire, you can get better access to medical care when you retire, now that's a great outcome, right? And uh, the language of e-commerce, right? The language of e-commerce is, if you want to look at an anecdote, right? In e-commerce, what they say is like
Yes.
they have this abandoned cart
Correct.
concept, right?
Yeah.
So now if you apply the same thing to investing, and you say, hey, you know what, you wanted to invest this mutual fund, but you didn't invest, now you should invest because it's gone up 5%. It's not apples to apples. In investing, if something has gone up, then you know its desirability as an investment has actually gone down. That's how investing really works. But the language of e-commerce will completely miss that. So some of that has to change. It'll take time because habits are also very ingrained, right? People in India expect, they're used to a loud form of communication and a loud form of marketing.
That means TV and TV and the likes.
So in a way,
Paper, front page ads.
the counter argument is, if you don't push, no one will hear you.
Yes.
So and it's a tricky situation, right? So for us, the answer is that you build a community. You get the community to speak for you. They get their friends involved. They get their families involved. I mean, we spend very little on marketing.
Just like a D2C brand. Let's just like some of these new age D2C brands. Yeah. Build a
You
community.
know, you can call it product market fit because people are talking about it to your friends. You can call it, you know, you can put a nomenclature on it, but essentially what is happening is you're basically saying, I want this to be so good for you, and I want you to realize that this is so good for you, and it might take you 1 year to realize that it's really good for you. It doesn't have to happen immediately, because anyways we're building a relationship for 10-15 years. But after that 1 year, you're going to go and tell 20 of your friends that, you know what, this is the only platform you should be
That
on.
is
And
so
that's
true. That
that's the
is
value.
true. That's great value. And you know, I want to talk about these events, right? I mean, we've lived in the longest bull run, right?
Right.
And it's as if people wanted the markets to fail, and you know, I don't know whoever wished for that, but I remember you in 2018 in the US, a lot of my friends saying, you know, we expect something to happen. We expect something to happen. Unfortunately, it was not the markets, but it was the pandemic that created the markets to go tank for a while, right? But they're coming back to the January levels, like you said. You know, the audience, right, have written to us questions when they knew that we're doing Fireside with you. They want to know, how did you plan as a company when this event happened? How did you manage all those changes? What are the learnings? How did you guide your, you know, customers, the happy Covarians, right? How did everything pan out between March and now?
See, for us, on the operational side, as
Yes.
a company, you know, we were lucky, to be honest, right? All our
Mhm.
processes already were completely digital, from middle office to customer office,
Mhm.
customer service. The transition itself wasn't much of a shock to us. The
Mhm.
only thing that changed was now we don't have any office, and We are a small team, about 55 people, and we work from 20 different cities. So operationally, it was very easy for us to absorb because we were anyways very distributed and very digital by that time. Um, the changes we saw from our users, a couple of things happened, right? So first, let's go through, the first was the behavioral, like how do you manage the behavior of the users, right? So early on, we started writing about, ups and downs happen in the market, kind of don't go ape shit, or don't do something that you might resent later. We focus heavily on asset allocations. I remember, I think March 12th or March 13th is when we sent out a newsletter saying, what, right now your asset allocation will tell you to sell debt and buy equity because equities are falling. That's what happens when equities fall. Your asset allocation tells you to sell debt and buy equity, and you should do that. Your gut will tell you this is the worst thing to do, but this is actually the right thing to do. A lot of people did follow that advice. Then
Nice.
fast forward to like about a month ago, we sent out another email
Go back to
saying the
equities.
exact opposite, that what, now if you would have done that rebalancing, then right now your equity allocation would be at least 10 to 15% away from where it should be. It's a great time to sell equity and buy back
Wow.
debt. So simple tools actually work fantastically well. Complexity in investing is really, really bad, right? So a simple principle we follow is that the more decisions you take, or the more kind of decision making paradigms you have, or more people you hear to, or more tips it's all going to be a disaster,
Okay.
right?
Okay.
So very simple paradigms. The basic, if someone comes to us and says, what, I want to retire rich, what should I do, right? It's a very simple answer. Be absolutely amazingly good at your day job. Get a 15% raise every year. Invest that wherever you want to invest that, because see, you can only invest what you earn. Maximize your earning potential. Your human capital and the ROE on your human capital is by far the most precious commodity you own. So don't
Absolutely.
spend 4 hours digging around on some, technical charts and oh, he said this, or this grapevine says that.
We
People
don't
get
have the time. It's not humanly possible.
and people get burnt all the time, right? I mean, you're spending 3 hours trading versus people who are doing 16, who are spending 16 hours doing the same thing and been doing it for 15 years, who
Yeah.
probably have an informational arbitrage, who
Yes.
get information before you get, right? So that was one part of it. On the product side, that was the other beautiful thing that we started seeing, was on the product side. People started demanding from us a lot of newer kind of products, right? So there were demands for loan products, insurance products, and we had to literally turbocharge our launch timelines. In the past, I think 7 months, we have launched a loan product, loan against mutual fund. We've launched international investing. We've launched equities with partnerships. So we are not a broker ourselves. And we recently just launched a group health insurance, right?
Okay.
So that has been a phenomenal journey for us, right? And that's
Mm.
almost always has been driven by our user base, the happy Koreans coming to us and saying, hey, you know what? Because suddenly when something like COVID happens, suddenly people realize, oh, I'm underinsured when it comes to health.
Yeah.
Suddenly people start thinking about, will I have a line of credit if something goes really bad, right? Can I get an overdraft mutual fund, which is loan against mutual fund? And it was really amazing that the team could step up and do this. But yeah, it's been, I think, we've done more more this year than I think the last 2 years combined. This has been fantastic in that sense.
Yeah, that's amazing to hear. I liked your point when we were speaking earlier that you said while salaries are down, costs are down, savings are actually up, and people can actually reinvest in markets, right? As that happened, one. Secondly, what type of people, come on to Kubera, right? I mean, that's something that I want to know. What age group? What are they looking at? What are the different investment strategies that different people look at? You talked about gold, but bonds, stocks, funds. There's also many Indians don't know that they can invest $250,000 abroad, also in
Yeah,
America.
yeah,
I'm
yeah,
sure. So that's another thing that you could talk about. And
sure.
what cities are very active other than Bombay and Delhi? I'd love to know what other cities are active. I hope the techies are
Bombay,
investing.
Bombay is the city of risk hai to ishq hai, right? So everyone knows that they do invest, and they invest like nutters.
Yeah,
Uh,
absolutely. So if you could take that question, it'd be lovely, please.
sure, sure. So In terms of cities, we are seeing a lot more broad-based here, kind of investing pattern, right? Cities like Ranchi, Bhilai, Bokaro, right? The steel cities, cities like, smaller
Okay.
cities in Punjab, and they're all stepping up in UP, the investors coming from Kanpur, and we are seeing some of that because, coming back to your first point, two things are happening. One is while earnings have come down, and the best way to kind of visualize what is happening is, um, people's income levels have come down
Yes.
on average, but the distribution is very barbelled. So what that
Okay.
means is 6% of the people have lost their jobs. 10% of the people probably have taken a 10 to 20 or 30% hit. Everyone else, same salaries, still earning the same salaries. Some might even have gotten a hike, right? So it's a very barbell distribution. There is a large majority of people whose income has actually not changed at all, right? Clubbed with the fact that your expenses have gone down for everyone.
Yeah, you don't
That is
travel
not
as
barbell.
much.
That is not
Yeah.
barbell. The expenses going down is for everyone, right? So, for example, I mean, we are a very small company, but we didn't cut salaries, or we didn't do anything of that sort, right? And I know of tons and tons of startups that didn't. Of course, startups who did got all the all the news stories and all the
Correct.
negative kind of things, but tons and tons of us didn't do anything. And a lot of corporates also didn't do anything. Of course, the public sector didn't do anything. Everyone in the public sector kept
Yeah.
getting the salaries they are entitled to. You can't touch their
Correct.
salaries anyways.
Correct.
So, but
And with a lot of government announcements, there's a flush of money, right? Because of government announcements, or at
and
least for the
expenses are
public
down.
sector.
Expenses are
Yeah.
down because you're not eating out. You're not going to the theaters. Transport is usually a big expense. Gas is a big expense. Petrol is a big expense.
Yeah.
All of that is coming down, and then eventually, what happens to that difference is that you have more spending power, but you don't know where to spend it because you're not going
Ex-
out.
Yes.
So you go online and you can start learning, and that's how a lot of people then say, okay, now suddenly I have this excess money, what should I do with it? Let me invest it. And it's a global phenomenon. It's not just in India, it's happening everywhere. We are seeing increased flows in equities from a certain set of user base, not from the entire ecosystem, but from a certain set of user base. We're seeing increased flows in equities, in international equities, in mutual funds, in gold. In digital gold, July, August was the best month we have ever seen. Like, I think
Okay.
July was like 6x of June. It was just, some of these jumps are just so amazingly crazy. You're like, wow, what just happened there, right? And it's just like this wall of money that comes from somewhere, and then that gets invested in an asset class. And like right now, we are seeing a massive jump in international investing. More and
Correct.
more people are realizing that it's actually quite easy to invest directly in the brand names and in the companies that you really
Yeah.
value, right? So, will this continue is the big question. The big question is, and that goes back to what we discussed earlier,
Mhm.
the people who are investing in this, and the kids who are investing in this, and you also asked about the kind of demographic profile.
Yes.
Our demographic profile skews slightly older, so we are the meat of our bell curve is 30 to 35,
Okay.
and
Okay.
two standard deviations would be
Okay.
like 25 to 40, right?
Okay.
So
Interesting. Interesting. So these are married kids who want to settle down, understand
yeah, so
saving,
exactly.
and
So it's
yeah.
a more, in a way, it's a more informed crowd. It's
Yeah.
right, and at least they do goal planning, and we are
Yeah.
fairly certain that they are long-term investors, and they're not just punting because they have
Yeah.
50,000 rupees more in the bank account. Yeah.
Interesting. Interesting. So, I mean, when they look at bonds, do they like bonds in India? Do they, I mean, or is it more equity? Because they,
Bonds,
they put,
buying.
they think
Go on.
bond as a debt here. They, bucket it under debt. They perhaps don't have a fair understanding of corporate debt market here, or a corporate bond market, right? And do you
Bonds
think
are
Indians should
hard.
get into
See,
bonds?
first of
They're
all,
hard.
yeah, the first thing is, buying individual bonds is hard because you have to do a lot of legwork. Uh, you have to do a lot of legwork, right? I mean, interest coverages, all those numbers are not easy to get if you want to be a good bond investor, right? And I don't think, a lot of people would have the time enough, to put the time and effort to kind of do that. Having said that, there are corporate debt funds, mutual funds that
Yes.
invest in corporate debt. But I
Correct.
think what we have mostly seen, at least in the past, I would say 5, 6 months, is that most of the demand has been on the equity side. There has been some demand on the debt side. Sovereign gold bonds definitely see a great amount of demand every time a new tranche comes in.
Mhm.
Um, but not so much bonds. Yeah. I think it also
Okay.
gets a bit technical,
Okay.
right? You have credit risk,
Yeah.
you have interest rate risk, and
Okay.
very, yeah.
Okay, perhaps, if they come and say, hey, I've got this platform that I go to that will tell me what to do. Would you say that platforms can suggest, perhaps even, if they're like, these investing apps, perhaps they're, maybe people believe that the fund manager is using, an AI tool to increase your revenues. But, for taking informed decisions for, in the consumer side, right? I mean, where do most people start? You would say that to learn this, start investing small amounts of money in different segments, and then make mistakes and start investing more for the amateur investor.
Yeah, so that's exactly what happens, right? And it's actually very sad that that happens because what I'll also tell you why. And there is most people say at least they're doing something, they're investing something, but that's not exactly how it plays out. Because what happens is, and how our brains are wired, right?
Yes.
People start with 10% of their say you have 100 rupees in your bank account, right?
Correct.
Or 100 rupees that you can invest. That's money that you don't need for the next 10 years, right?
Correct.
You'll invest 10 rupees. And then what will happen is suddenly you are focused on that 10 rupees like that's everything. And you want to make 20% on that 10 rupees or 25% on that. You're chasing returns like crazy because you want to make the highest return possible on that 10%,
Correct.
10 rupees, right? You want to be in Tesla when it goes up 10%, and you want to be in Zoom when it goes up 20%.
Correct.
All in the same month. Of course, not possible, but that's how the brain. So, but what actually happens is you're so focused on that 10 rupees that 90 rupees of your wealth is earning zero returns.
Yeah.
We call it cash drag. Cash drag
Yeah.
is essentially, you are mathematically put, it's really simple, right? You're better off investing 100 rupees at 10%
Yes.
than investing 10 rupees at 50%.
Wow.
How likely are you to get a 50% return?
Mm. Mm.
How easy is it to get a 10% in the long run? I mean, I shouldn't say easy, but at least
It's easy.
it's a
10%
good
is easy,
expectation.
right?
It's a good
10% is an
expectation
easy
to
thing.
have. I
Yeah.
mean, whether you get it or not is a different story, but it's a good expectation to have, right? So when people start small, what happens is their whatever
Mm-hmm.
happens, recency bias takes over. If
Mm.
they get really good returns, they start chasing it massively and they start investing at higher. If they have bad returns, then they never invest the remaining 90. So it's
Okay.
actually a better idea. It's a better process to say, okay, these are my big goals. Of course,
Mm.
definitely put retirement in there.
Mm.
Then invest the entire 100 in one go across 2 or 3 different assets,
That's fantastic. Okay.
fully vested, and then you are asset allocating and you're
Mm.
rebalancing every 6 months, 1 year, or whenever the asset allocation moves by 5 to 10%. Now, you might think, no, because our tendency is always to test the waters.
Yeah, and don't churn. You're saying don't churn in 6 months,
Don't churn. I
3 years.
see, rebalancing should happen based on how far you are from your expected asset allocation, right? If your asset allocation is 60-40 and you go to 80-20, you should rebalance. If that happens in 1 month, you should rebalance in 1 month. If it happens in 3 years, you should rebalance in 3 years.
Okay.
There is what is so magical about the 1 year number that you should rebalance in 1 year? Nothing actually.
Okay. Yeah.
What's so magical about the 1 month number that you should rebalance monthly? Nothing actually. But if your asset allocation is quite far from where it should be, makes a lot of sense to rebalance there, right? So we basically we recommend like up to 5 to 10% of mismatch is okay, one way or the other.
Okay. All the
But
rebalancing is done by these, like the guys who trade for what, 16 hours a day. Those are the guys who take such bets, right?
see, they are trading. They are trading very differently. They
Yes.
are trading on. Every market has something called a market microstructure. They are trading on those microstructure inefficiencies, which you will never
Correct.
be able to capture.
Absolutely. That's why the amateur guys
You
should
can't
stay
go to
invested long.
Microsoft code for 10 days, 10 hours, right? Really, like, job that requires a lot of your mental power, energy, and then come back, sit for 2 hours in front of some, new age stock guru, and then expect, yeah, next day I'm going to make
Yeah.
5%. I mean, maybe one day it happens, 4 days it happens. I mean, the evidence is very, very clear.
Right.
The
Right.
evidence is very, very clear.
Yes. I want to, talk about the segmentation of the population now, because I'll do a demographic segmentation, and I hope more people get to work, because the blue collar, white collar workers, because there are questions around amateur investing and people from small towns investing. So I want to talk about this. say a 21-year-old starts working, it can be tech, retail, obviously the salaries vary 10, 15%. And everybody starts with a goal, right? But parents tell you to take insurance. That's the first thing. Yeah, insurance given, get yourself a health insurance because you're young, right? But when you've got to start investing in stocks, would you say put aside 5,000? Because somebody was telling me, I think this was a chartered accountant was telling me that India, only 1 million Indians earn more than 30 lakhs per annum. And that's a problem, he said. But if somebody's starting out small and has great goals to start saving, like you said, work hard, get 15% year on year, invest that 15% into the markets, right? Can they start at 21 and what amounts do they start putting in? Then I want you to move on to the married 35 to 40. How do they behave? And then 45, people who are late, who want to start now, 45 to 60. How can they, also focus on saving and betting on equity?
So the first thing you have to do is that don't anchor on the age of the investor.
Okay.
It's a pointless number. What
Okay.
matters is how far you are from your retirement.
Okay.
If you're more than 15 years away, then it doesn't matter whether it's 25 or 30. You can pretty much take the same amount of risk.
Okay.
So a 20-year-old versus 30. Right? So and the other thing I would say is don't anchor on how much you should start investing in.
Okay.
You could be a 22-year-old making, I don't know, 25 lakhs and your expenses are only 5 lakhs. You can probably start pretty big. So contextualize everything based on your income, your expenses.
Okay.
And so the first rule of thumb, get an emergency fund. Emergency fund is like 6 to 12 months of expenses.
It protects your parents, everybody at home. So
you lose your job, you're not pulling out your head, you're not selling your stocks because you don't have money to pay rent.
Are there such funds? Really?
No. Emergency fund is just the name. Emergency corpus, that's just put that in your savings bank.
Oh, that's your savings bank. That's an FD kind of a thing.
FD, savings bank,
Okay.
Anything above that, just invest. It doesn't matter what the number comes out to be. The number comes out to be 300 rupees, invest 300. The number comes out to be 3 lakhs, 3 lakhs. So,
nice.
Because what happens?
You're saying don't compartmentalize.
And don't anchor on this perception of this, because a lot of these words of wisdom are actually pretty hollow. Like, why should everyone start with a 5,000 rupees SIP? 5,000 mein koi magic to nahi hai.
Correct. Absolutely.
Right. So contextualize it to your stage of life, where you are, what your income is, what your expenses is, what your goals are, right? And that's the right way to think about it. Once you start thinking along those lines, then it's actually really, really easy.
Gaurav, that's been a wonderful fireside chat with you. And, this topic on investing in the new normal, I think it's more about how people perceive the future. It's more about how people have to experiment a lot more, be free from all this information that flows. Just go and try out a product digitally. And if it works for you, fine. Otherwise, you're happy with doing something else, please. Right. But the future, according to me, is digital, because I have not visited a bank for 6-7 years. But the only mistake I've made is the fear of losing money 12 years ago has not taken me back to stocks, which I must after this conversation. I hope you guys have learned a lot more. Send in the questions. I'll get Gaurav and his team to answer it for you. Gaurav, lovely. Thank you very much.
Thanks, Vishal.